Hey, what's up? So you've got $1,000 burning a hole in your pocket, and you're wondering where to put it. Maybe you just got a bonus at work, or you finally saved up enough to start investing. Either way, you're in the right place. In this video, I'm going to walk you through exactly how I would invest $1,000 right now, step by step, as a beginner. We're not talking about risky crypto bets or penny stocks. We're talking about a realistic strategy that you can actually use today. First things first, let's talk about where your money currently sits. If it's in a regular savings account at your local bank, you're probably earning almost nothing. Interest rates have shifted, but most traditional savings accounts are still offering less than 1% annually. That means your $1,000 is basically just sitting there, losing value to inflation. So the first step is to move that money into a high-yield savings account as a temporary holding spot. This takes 5 minutes online, and you'll actually earn something while you're making your investment decisions. Now, before you invest a single dollar, you need to ask yourself one crucial question. What's your time horizon? Are you investing this money for next month, next year, or the next 10 years? This matters because it determines what you should actually buy. If you need this money within the next year or two, stocks are probably not the right move. But if you're planning to leave it invested for at least 5 years, maybe even longer, then we can talk about equities. Let's assume you're playing the long game here, because that's where real wealth gets built. Okay, so you've decided you're investing for the long term. Now comes the second step, and this is where most people get confused. Should you pick individual stocks? Should you buy real estate? Should you start a business? Here's the honest truth. For someone with $1,000 in limited experience, individual stocks are probably not your best bet. Not because you can't make money, but because the odds aren't in your favor. Most individual stock pickers underperform the market anyway. Instead, I would put that $1,000 into index funds or exchange-traded funds, which we call ETFs. Think of an index fund like buying a tiny piece of 500 different companies all at once. When you buy an S&P 500 index fund, you're literally owning a fraction of 500 large American companies. If one goes down, it doesn't matter much, because you own 499 others. This is called diversification, and it's basically free risk reduction. The most famous index fund is the VTSAX, or similar, which tracks the entire US stock market. There are also international options like VTIAX if you want exposure outside America. Now, let's talk about the third step, which is choosing your broker. This is the company where your money will actually live. Popular options include Vanguard, Fidelity, Charles Schwab, and others. Most of these now offer zero commission trading, which means you can buy funds without paying a fee. You open an account, link your bank, transfer your money, and boom, you're ready to invest. The whole process takes less than 30 minutes from start to finish. Here's what I would personally do with that $1,000 if I had it right now. I would split it up. I would put about $600 into a total stock market index fund. This gives you broad exposure to American companies of all sizes. Then I would take another $300 and put it into an international index fund. This gives you exposure to developed markets like Europe and Japan, plus some emerging markets. The last $100 I would actually keep in that high-yield savings account as an emergency buffer. Why? Because life happens, and you don't want to be forced to sell your investments at a bad time. Now, once you've made these purchases, here's the fourth step that most beginners skip. You need to set up automatic contributions. Even if you can only invest $50 a month, that's better than nothing. You set up an automatic transfer from your checking account to your investment account every single month. This is called dollar cost averaging, and it's one of the most powerful tools in investing. You're buying more shares when prices are low and fewer when prices are high, automatically. Over time, this smooths out market volatility and builds real wealth. The fifth step is actually the hardest one, and that's patience. You've invested your $1,000. Maybe after a few months it's worth $950 because the market dipped. Your instinct will be to sell and cut your losses. Don't do that. The market always recovers, always. Every single downturn in history has eventually reversed and hit new highs. The people who get rich investing are the ones who don't panic. They buy when everyone else is scared, and they hold when everyone else is impatient. Now, let's talk about taxes for a second. If you're under 35 or 40 years old, I would open this investment account as a Roth IRA instead of a regular brokerage account. Roth IRAs have serious tax advantages. You contribute after-tax dollars, but then everything grows completely tax-free forever. When you retire, you can withdraw that money without paying any taxes on the gains. A Roth IRA has an annual contribution limit of about $7,000, So your $1,000 fits perfectly within that. Even better, if you're young and don't have a ton of earned income, you might qualify for the Saver's Credit, which actually gives you free money from the government just for investing. The sixth step is to educate yourself while your money is working. I'm not saying you need to become Warren Buffett, but you should understand what you own. Read 1 or 2 books about investing, listen to podcasts, follow along with what's happening in the world. The more you understand markets and companies, the more confident you'll feel holding through downturns. Knowledge is the best antidote to panic. Here's something else nobody talks about. Investing is actually boring, and that's a good thing. The traders on CNBC who are constantly trading and looking at screens every minute, most of them underperform a simple buy and hold strategy. Your job is to invest, set it, and largely forget about it. Check your account maybe once a quarter, not every day. Daily price movements don't matter for long-term investing. What matters is that 10 years from now, you've been steadily adding money and letting compound growth do its thing. Let's actually talk about what compound growth might look like. If you invest that $1,000 today and never add another penny, assuming an average return of 7% per year, in 10 years, you'd have nearly $2,000. In 20 years, you'd have about $3,900. In 30 years, you'd have over $7,000, and that's from just the initial $1,000. When you start adding even modest amounts like $50 or $100 per month, those numbers get exponential. That's the real magic of investing. Time plus consistency plus diversification equals wealth. So to recap everything, here's the step-by-step process. Step 1. Move your money to a high-yield savings account temporarily. Step 2. Decide your time horizon and confirm you're investing for the long term. Step 3. Choose index funds or ETFs as your vehicle. Step 4. Select a broker like Vanguard or Fidelity and open an account. Step 5. Split your $1,000 across different funds for diversification. Step 6. Set up automatic monthly contributions. Step 7. Understand the tax benefits of a Roth IRA. Step 8. Educate yourself about investing. Step 9. Stay patient and resist the urge to panic sell. Step 10. Let compound growth work its magic over years and decades. That's it. That's how you invest $1,000 right now as a beginner. It's not glamorous. You're not going to get rich overnight. But you're going to build wealth systematically, and that's what actually works. Thanks for watching, and good luck out there.